Good morning, everyone, and welcome to the QPM Energy Investor Webinar. I'm Jane Morgan, Investor and Media Relations Manager, and today I'm joined by our CEO, David Branch. This morning, David will walk you through an overview of QPM Energy's recently announced full-year financial results for the 12 months ended 30 June 2025. After the presentation, we will move on to a Q&A session. So to ask a question throughout today's webinar, please use the Q&A function, which can be found at the bottom of your screen. David, I'll hand to you.
Yeah, thanks very much, Jane. And let me add my welcome to everyone who's attending the webinar this morning. I'd like to spend a little bit of time today just walking through what we at QPM Energy have achieved over the 12 months to June 2025. It's been a very, very significant year for the company. And in addition to our financial results, which we will talk through, we have achieved a number of very, very key milestones during the course of the year. I might just mention some of those before we start, and then I'll just move through into more of the detail on the financial results. But I'm very pleased to report that our focus for the year was on a number of key elements in the business. The first one, of course, was continuing to work on improving our operational performance at the Moranbah gas field, our gas project. And we've made some significant progress in both increasing production and also, pleasingly, increasing our reserve base. So we now have over 435 petajoules of 2P reserves, and we're very excited about the prospect of significantly increasing that over time. We also had a major focus on restructuring some of our key commercial contracts. And the key ones that we focused on for the year were for the North Queensland Gas Pipeline and also for the capacity or the dispatch capacity on the Townsville Power Station. Both of those contracts were successfully renegotiated and have started from 1 July this year. And I'll talk a little bit more about those contracts and specifically the impact that they will have on the company going forward. And we also made significant progress on our key next growth element in the business, which is the development of the Isaac Power Station and the Isaac Energy Hub. So I will spend a little bit of time updating everyone on where we are with that project currently. So it was a very, very significant year for QPM Energy. And not only have we built a very solid operating platform to move forward, but we've also really moved forward in terms of a growth plan for the business. And we feel that we're very well positioned for the coming financial year to deliver an excellent financial performance, as well as continuing to grow the business with a range of opportunities ahead of us. Turning to the financials, I guess it was a number of positives for the year. The key positives, we had a significant increase in revenue for the year. We're up about just over 12% for the year to $120 million of revenue compared to FY2024. Largely, that was driven by a significant increase in electricity revenues for the year. So we generated about $53 million in electricity revenues, which is up about 30%, over 30% from the FY2024 year. And effectively, we ended up making an accounting profit for the year, a maiden profit for the company of $8.2 million. So financially, it was a good result. I would note, however, that a large proportion of the revenue and the contribution to profit was a result of non-cash revenue adjustments, which were required under accounting rules. However, it does show that the business was able to generate a statutory profit for the year, which is very, very pleasing. Other key elements that I wanted to talk through today were we were able to reduce our unit gas supply costs. So our dollars per gigajoule, our gas supply costs came down for the year, which was a great achievement from the operating team. And of course, with the pivot in the business to focus on the energy activities, we were able to significantly reduce our expenditure on the tech project during the course of the year. So our focus is clearly on growing energy, whilst we still have a small team working on the tech project, our business is really driven by the opportunities we have ahead of us in developing our energy business. Just spending a bit of time breaking down the revenue, our annual revenues. You can see from this particular chart that the bulk of our revenues, or a significant proportion of our revenues, is now coming from electricity sales, and that was up significantly from the previous financial year, which was very pleasing. Our gas sales revenue was similar, up a touch, but very similar from the prior year. And we have in the grey portion of the bars here is the accounting adjustments, which if you read through the detailed financial reports, there's a detailed reconciliation of what those accounting adjustments actually relate to. But essentially, they're relating to the legacy contracts that we inherited at the time we purchased the asset. Those accounting adjustments have essentially now washed through as at the end of the FY2025 year, so we will see minimal impact for those kind of adjustments going forward, and we'll be reporting our revenues and costs more closely related to the actual revenue and cost the business is generating. The key driver in terms of increase in electricity revenues was our ability to operate the Townsville Power Station and dispatch it successfully, and in particular dispatch it successfully to capture periods of price volatility that were experienced during the course of the year. And our energy markets team did a great job in ensuring that we were running pretty much every time there was a major market event, and we captured pretty much all of them during the course of the year. So that was one of the key drivers of our growth in electricity revenues. We also, as you would be aware, we acquired the capacity for the Moranbah Power Station in December, or late at the end of December in 2024. And that whilst it's a small unit, it's about 12.8 megawatts, it actually enabled us to significantly reduce our costs of electricity supply for the project, because it does supply our gas field directly. And we were also able to generate some export revenues, or export electricity to the grid, and earn revenue there. And in particular, during the June quarter this year, when the Townsville Power Station was undergoing its major turnaround, the MPS, we ran the MPS pretty hard, and it was able to generate some pretty decent revenues. I think it's also worth noting that increase in electricity revenues was in spite of the fact that TPS, the Townsville Power Station, was actually not operating for 3 months from the end of March through to the end of July this year. So if you look at our run rate, and I think this is a very interesting chart, but it shows, the green dots and line is our quarterly revenue on a cumulative basis for the FY2025 year compared to the previous year in grey. The September quarter, obviously, in FY2024 was the period when we first acquired the MGP assets, and we only really had 1 month of revenue, so that's why it's so low. But you can see consistently in 2025, in the current financial, or the most recent financial year, we have significantly outperformed our achievements in the 2024 year, with the exception, of course, of the June quarter when Townsville was offline. If we'd had Townsville online, I think we would have had a very, very substantial increase in electricity revenues for the year. So this is a key element of our strategy going forward, because we have been able to demonstrate that we have the capability to generate significant revenues by converting the molecules of gas we produce at Moranbah into electrons, and by using the pipeline storage and flex capacity that we have available, we're able to really optimize our generation to really hit the increasingly volatile price periods that we're seeing in the Queensland electricity market. So we think our performance over the last couple of years really does vindicate and underpins our strategy going forward, which is essentially to increase our generation capacity over time through the development of the Isaac Power Station. Just a little bit more detail on the electricity revenue generation. About 200,000 megawatt hours were generated by TPS in the 9-month period through to the end of March 25. MPS performed very strongly in the 6 months that we owned it through to June 25, and we saw an increase in prices, particularly for TPS. We ended up getting about just under $250 a megawatt hour for the year. MPS achieved a lower price, about 144, but it was running much longer in terms of running into lower price periods of the day, particularly during the June quarter when we had excess gas available, and we ran it for much longer periods during that June quarter. So again, we think a good result from both a quantity of electricity or volume of electricity generated, but also pricing, realised prices. That translates into a gas price. So the effective price we got for the gas that was consumed by the power stations. So TPS was earning us, or Townsville Power Station was earning us in excess of $20 a gigajoule, and MPS was around about just under $10 a gigajoule. So very, very good returns from a gas perspective. And in particular, those who follow the gas market will know that domestic gas prices at Wallumbilla are around about $12 to $13 a gigajoule. So we believe that we're well positioned to be able to attract or earn a premium margin for our product through intelligently monetizing it through electricity generation. In terms of operating costs, our operating costs were relatively stable for the course of the year, and really our reduction in unit costs, which is in the lower chart there, lower graph there, really was driven by an increase in field supply. So we feel that, I guess going forward, as we continue to build supply over the coming 12 months and 2 years leading into the commissioning of IPS, we feel that our unit costs will continue to come down, mainly because the cost of running our business is fairly stable, and we have capacity within our existing team and asset base to increase production without adding any incremental operating costs to our business. So I think we'll see that unit operating costs come down, and that's one of the key drivers of the cost competitive position that we have through IPS. It'll be a very competitive asset, mainly because of our very low cost, or our increasingly low cost gas supply operations. Our focus for gas supply has been around real operational improvements. So we've been doing made a whole raft of improvements in the way we manage our wells, the way we manage our gas gathering system, and we've been able to increase production and increase reliability across our system as a result. As we go forward, we're now ramping production up following the Townsville, well, now that the Townsville Power Station is back online, and we're now starting to do some significant work in the field to start to take the next step up in production over the next 6 to 12 months. I guess, as well as focused on our gas supply and operations and electricity dispatch, we have been quite active we've had a number of quite active capital expenditure programs during the course of the year, and these have all been geared around improving and increasing production in particular. We drilled the Teviot Brook production wells. We've done a number of well workovers, which is to bring existing wells back online. And we've also done a lot of work to debottleneck the gathering system. And the reason for doing that is as we see production increase, we had experienced some areas in the gathering system where there was some constraints, which was leading to higher pressures across the field. So we've been able to work to remove some of those constraints and maintain low pressures, which is critical to maintain production and increase production. We also received some funding from the Queensland Government for an exploration project in a seam called the Fairhill Seam, which sits above the Moranbah coal measures from where we produce the bulk of our gas currently. We're just dewatering that particular well at the moment, and we're seeing some interesting responses in terms of gas pressure building in the well. We're taking it very slowly, but it looks like it could be an interesting well as we continue to dewater and start to bring that well into production from a gas perspective. That seam is a very extensive seam across our permit area. It's not included in any of our resources and reserves. It was an opportunity for us to try and test this seam with the assistance of the Queensland government. The bulk of our capital expenditure has been funded through our development funding facility that we have in place with Dyno, and we have significant capacity available under that facility, which will continue to fund these types of activities in the current year and in the FY2027 year. So we appreciate the very strong support we receive from Dyno, and we work very closely together, but they're very, very keen to see us continue to develop the field. Of course, they're a beneficiary of that because they receive gas supply directly from the field, but they also appreciate that as we grow production, it de-risks their gas supply, and they're very, very, very supportive of our development activities and plans. I did mention earlier that one of the other significant achievements during the course of the year was the reset of the contracts we have for gas transportation and storage on the North Queensland Gas Pipeline, and also the dispatch of the Townsville Power Station. Both those contracts were legacy contracts that we inherited when we acquired the assets, and as I think shareholders and everyone's aware, were a significant cost. And in FY2024, those two contracts cost us about $60 million for the year, and in FY2025, it was just over $50 million. And of course, that was for the 9-month period because we didn't really have any costs during the period when the Townsville Power Station was being overhauled. So it's a very significant cost for the business, which we've now restructured. And as a way of trying to illustrate the impact on the business tangibly, what we've done is recalculated we've basically reset the cost structure for both FY2024 and FY2025 on the basis that the new contract terms were in place during those periods. And you can see here the green cost bar, substantial savings over what we actually incurred. And so just to give shareholders a bit of a sense of how significant the reset on those commercial contracts are, it's just a way of trying to show it clearly. But we expect there to be circa $30 million of benefit in the current financial year, starting from 1 July, which we're right into now. So it really does materially impact the profitability of the business. And I think it's been one of the biggest achievements that we've made in the last year was to get ourselves into that position. TPS did return to service in late July 2025. Unfortunately, that was about 4 weeks behind schedule. And so we are about a month behind where I would have liked to have been at this point in time in terms of gas field ramp up, because we had to put the brakes on the gas field in July, which was unfortunate. But we're working through that now, and we're back up and running comfortably, although we have lost a bit of time because of that delay in getting Townsville back online. Although I am happy to say that the power station is running very well. There's been no issues, and we're seeing a very good performance from it following the overhaul. In terms of the FY20, our expectations for the next 12 months, we expect we've got a number of projects on the go. We're looking to continue to grow both our gas and electricity sales revenue, particularly our electricity sales revenues. We will see the benefits, the cost reduction benefits coming through as a result of the restructuring of the Townsville Power Station and North Queensland North Queensland Pipeline contracts. We're looking to continue to grow production, and we're working on a number of projects to connect in third-party supply, which will also assist us in growing overall supply that we have available for both dyno and power generation. We have a near-term objective of achieving FID on the Isaac Power Station. That's moving very, very rapidly, and we're making some excellent progress in terms of finalising approvals and the procurement of the main component, which is the gas turbines. And then we're starting to turn our minds to what's next. And clearly, we're developing the power station as a first stage of this Isaac Energy Hub, and we're looking at how we can, options to grow our capacity at that hub significantly using the base infrastructure that will be developed as part of the initial stage one Isaac Power Station build out. So in terms of numbers, we are looking for a gas supply number of somewhere between 10, just over 10 and just over 11 petajoules for the year, which is between 28 and just low 30s in terms of TJs per day. Gas sales are fairly stable. We have really two gas customers, that's Dyno and CRL in Townsville. That's very stable. And then the balance of the gas will be just going towards electricity dispatch. And so, on that basis, we'll be looking to generate something like 170,000 to over 200,000 megawatt hours. Our cost structure, as I mentioned previously, very stable. And that's very much in line with FY2025 and really doesn't move or doesn't vary much with volume. We're a fixed cost business essentially. And you can see there that the gas transport and electricity generation costs, which are the pipeline and power station agreements we talked about, are somewhat related to our revenue generation, and that's particularly the power station. So we have a slightly higher cost as we produce more electricity. But conversely, if our electricity revenues are lower, our costs flex down. So we have effectively a flexible arrangement, or a part of the agreement, particularly with RATCH, is around providing us with a flexible cost structure rather than a fixed cost structure, but in any event at a much lower level than we have been previously paying. That translates into gas field unit operating costs, something like $4.20 down to sub $4 in the upper case. And I think from my understanding of the Queensland gas production industry, that's a pretty competitive ex-field cost of gas. So we're very pleased to be, and our targets are to get below $4. And that's a very, very important asset for this business to be such a low-cost producer. And the total cost, if you include our infrastructure, pipeline and power station costs, around about $7.30 a gigajoule. So you can see that if we're able to generate from the electricity component of our revenue stream circa $20 a gigajoule or north of $20 a gigajoule, compared to our cost of around $7.31, it's a business that does have the potential to generate strong operating margins. That's it, Jane. I can talk some more or answer some questions, and happy to do so.
Yeah, wonderful. David, we do have lots of questions coming through. And again, I remind webinar attendees to please use the Q&A function, which can be found at the bottom of your screen. Let me jump into it. So first one, how has TPS performed post-maintenance? And is August indicative of a typical month without that volatility or peaking, which is generating around 15 to 16,000 megawatt hours at around $150 per megawatt hour, which is resulting in 2 to 3 mil per month?
Yeah. So I think there's a couple of questions there. The first one is the power station, after coming back online, is running really well. We're seeing it run a slightly better heat rate than it was before, so its efficiency has improved a little bit, which is great. So it's running well. It's being dispatched well, and we're pretty comfortable with the performance of the power station. Electricity pricing during August and September has been pretty soft, and we haven't seen a lot of volatility in the market. But then that's not unusual. We're right in the middle of the actually the weakest part of the year as we transition from winter to summer. So we're in the spring. So I'm not too concerned about it. Clearly, we'd all like higher prices for that period, but to be frank, it's always the softest part of the year. Our focus is on ensuring that we've got our gas supply really, really driving hard through the back end of October and into November, which is the time when we start to see the transition and we start to get some more significant heat events in Queensland in particular. And we all know that those are the periods when we see the opportunities for QPM to do well in the market in those times. So, yep, it's soft. I would have liked to have been able to be generating in July because there was some good pricing in July. That was very disappointing. But August, September is, really well. It was always going to be soft.
Thanks, David. So next one is, there's been a lot of discussions about batteries. So how do you see this impacting QPM's electricity business?
Yeah, that's a good question. There is obviously a lot of battery. There's a lot of investment in new battery capacity in Queensland and elsewhere across the NEM. And so I think we see that as. I don't think we see it particularly as a potential major issue for us. And there's a couple of reasons for that. What we're seeing is that the batteries are typically running at maybe 2 to 4 hours of dispatch capacity. We obviously target running a little bit longer than that, and we're more consistent than batteries in terms of dispatch. And the other thing that is becoming the market is becoming somewhat aware of now is that when batteries are dispatching, and in particular in some areas of the grid, they're actually being substantially curtailed because all of the batteries can't get all of their electricity and energy into the grid at the same time. And that's mainly because of the grid itself capacity constraints. So if you actually look at battery dispatch, you'll see that most batteries are not dispatching at their full rated capacity, and that's one of the reasons. So we're fortunate in that we sit in an area of the grid, both in Townsville and also in Moranbah, where it's unconstrained. So we can always get all of our energy into the market at the right time, whereas increasingly batteries are going to be essentially congested and constrained in terms of their dispatch. So whilst we are going to absolutely see more battery storage into the market, I suspect there will still be very significant price and volatility events in any case. And so, I think in my sense of it is that the Queensland market in particular needs as much firming and storage as it can get. So we need to have more gas generation, and we also need to have more battery storage because I think the scale of the mismatch between peak demand and particularly generation supply during the evenings that gap is getting wider and wider and wider. So we actually need both.
Thank you, David. Okay, next one we've got, so you mentioned a 6.2% reduction in gas supply unit costs over the year. So can you talk about what drove these efficiencies and whether there's scope for further improvement?
Yes, the reduction in unit cost was primarily driven by an increase in supply or increase in throughput. So our overall costs were fairly stable around about that 44-45 odd million dollar mark. So the primary driver of the reduction in unit cost is volume. We don't expect that to change, i.e. we don't think that, we're not seeing any material increase in operating costs in the next few years, but we are seeing and expecting material increase in volumes, and so therefore we should see a continued decrease in unit operating costs.
Okay, next one. So were there any financial or contractual penalties for TPS being delayed for a month?
No, unfortunately not. Unfortunately, the way the contract is set up is that the old contract effectively expired at the end of the maintenance and overhaul period, and our new contract started from that date. So, unfortunately, we didn't have the ability to recoup any costs or charges as a result of the delay. I mean, just to put it in context, this was a fairly significant overhaul. I mean, the whole turbine was effectively disassembled and rebuilt. So it's almost effectively a new unit. It was a major turnaround, and it was disappointing that it was a couple of weeks, 4 weeks delayed. But there's not much, unfortunately, that we could do about it.
Yeah. That was more about the penalties occurred, but that's okay. We'll go into the next one.
Yeah, no, so there wasn't any penalties that were contractually available, that we could contractually access, no.
Okay. So next one, with the cost reduction achieved from the new TPS and NQGP contracts, is there also a corresponding reduction in revenue due to revenue sharing, or is the benefit illustrated on that bar chart, is the net benefit?
Yeah, no, it's a good question. The TPS revenues there'll be gross revenues generated from TPS, and then there will be, as the question rightly says, there will be a reduction due to the revenue sharing as between ourselves and RATCH. But it's not going to be a material impact on our overall revenue. So, yes, the answer is yes, but it's not a material impact.
Wonderful. Okay, the next one is we've got quite a few in here, but let me just jump into it. So, could you provide a timeline for the commercialization of the Isaac Power Station, and when are we expecting it to begin contributing to revenue?
Yeah, so the current schedule is that the power station would be commissioned in July 2027, so a little under 2 years from now. And we're working, actually, that is starting to get firmer as we work through the various elements of the project development plan. So, just going through the key elements in terms of the plan. The gas turbines, as everyone's aware, we've entered into a contract to acquire those. We've paid an initial deposit, and we will be in a position to pay the balance of that in the near term. And that will lock those in, and they will then be delivered and will be on site in Moranbah in March, April next year. Then there is a 12 to 18-month process for the installation of those units and connection to the grid and the gas and water and so on. So that part of the project is well in hand. The major critical element in the timeline is the grid connection, and that we're working with PowerLink on that currently, and we're expecting an offer to connect imminently, and then that will then trigger the work that PowerLink do to actually build the connection within their existing substation. So at this stage, we're pretty comfortable that all of those elements are on track. With the development approval, we have just lodged the approval process is well underway. And we don't expect that to be a major issue in terms of the overall project timeline. And we expect to be in a position to be taking a final investment decision. I mean, we kind of already have, but in terms of formally kicking off the construction elements in first quarter next year.
Thank you, David. Time for a couple more. So, are there any gas fields you could acquire close to the assets?
Oh, are there any gas fields? Yes, there is a very significant, obviously, resource play available in the Bowen Basin, and I think one of the things that we've done successfully is demonstrate that Bowen gas is commercial, and as a result of that, the areas that are adjacent to us are all of a sudden becoming very attractive because we've effectively, I think, shown a pathway to unlock how to produce the gas from these coals economically. As probably as shareholders are aware, we operate a permit called PL486 just to the north of the Moranbah Gas Project on behalf of Arrow. And there's a very substantial gas reserve there, which we are looking to work with Arrow to develop. That's already connected into the MGP system, and we're working very hard with Arrow to help and assist and promote a development of that resource or reserve. We have some other operators adjacent to us. Blue Energy has a permit right next to ours, and we've been doing discussions with Blue around how we can work together to underpin a larger development in the Moranbah area. And there are obviously operating mines all around this area that we're also continuing discussions with around connecting the gas that's already being produced as a result of mine drainage activities into the Moranbah, into our existing gas gathering system. So we've got a number of initiatives in train geared to incrementally adding both reserves and production to our current base. While we've got a near-term focus, which is to get the Isaac Power Station up and running, in parallel, we're really trying to consolidate and underpin a much larger opportunity for a much larger development in the Bowen, with the potential effectively to connect into the Gladstone and the main Eastern States gas network. We have a little way to go there, but we know for sure the gas is there. We've just got to be able to make sure that we can aggregate it in a way that's commercially feasible.
Thank you, David. We are running out of time here, so I'm just going to jump into the last one. So FY2025 was described as, a year of transition. So I think just for webinar attendees online, looking ahead, what should they be looking forward to from a news flow perspective over the next 3 to 6 months?
Yeah, I think the key near-term developments for the company are focused around the next stages of the development of the IPS, and that includes both completion of the final engineering design and costing work, which is well underway, securing the final payment for the gas turbines, and also the financing for the overall project development. And we're well advanced, both with a very substantial debt package that will fund a good portion of the capital cost, and we're working to look at ways to fund the equity component that will be required. And that's our kind of goal for the next 3 to 6 months, is to ensure that we've got all of those elements complete, and we're moving into effectively a construction phase in actually the first half of next year.
Wonderful. Well, that's all we've got time for today. If we didn't get to any of your questions, please feel free to reach out via the contact details, which can be found at the bottom of our ASX releases. But thank you again for your time.
Thanks very much. Thanks, everybody.